Hello everyone. Once again I welcome you all in our new question discussion and I hope you all are getting benefit from this type of videos. If you are liking such video, just inform me by way of message in the comment box. I'll be waiting for your message. Can we start a discussion? In this video we'll take two new questions from India's 102 chapter. One question was asked in November 2003 exam and one question is given in RTP of May 2024 attempt. Let us take first the question which was asked in November 2023 exam. However, the similar question I have taken in my class, which I have taken from the old resource of ICAI. Old resource means when we used to do CA, that time some question was based on some guidance note. So, similar question was asked in exam. Let us read the question. A Limited announce a stock appreciation right on 1st April 2020 for each of its employees. The scheme gives the employee the right to claim cash payment equivalent to an excess of market price of company shares on exercise date over the exercise price of 250 per share in respect of 100 shares subject to a condition of continuous employment of 3 years. So this is a question of SAR, cash settled SBP. The SAR is exercisable after 31st March 2003, means can I say 21, 22, 23 means the vesting period is 3 years. But before 30th June 2023, the exercise period is from 31st March to 30th June, means we can say 3 months. The fair value of SAR is 42 in first year, 46 in second year and 48 in third year. Of course, we all know that cash settled SBP plan will be reassessed, means the SBP liability will be reassessed at the end of each year during the vesting period. In the first year in 2020-21, the company estimate that 2% employee shall leave the company annually. So 2% employee will leave the company annually. This is for they have given the estimated departure rate of employee in the first year. This was revised to 3% in the second year 2021-22. Actually, 15 employees left in the first year, 10 employees left in the second year, 8 employees left in the third year. The SAR therefore actually vested on 492 employees on 31st March 2003 and when the SAR was exercised, the intrinsic value was 50 per share. Compute the fair value method. By fair value method, the SAR expense for the financial year first year, second year, third year and fourth year. Fourth year is during exercise period. Also provide SAR ledger, means we need to prepare one SBP liability account from inception till closure. Discuss whether this account is in the nature of liability or equity. Of course, the account will be in the nature of liability. So very simple question. The same question we have done in the class, but when I have done in the class, I have said that for this type of question, two assumptions are available about this 2% departure rate, annual departure rate. So I have said that in class when I was doing the similar question, I used to say that two assumptions can be taken. One, that we can assume that this 2% annual departure rate is for the entire vesting period, or we can also assume that 2% annual departure rate is for the remaining vesting period. Remaining vesting period means first year this estimation has been done for second and third year. Second year this estimation has been done for third year. So these two assumptions can be taken. However, in the solution they have taken the second assumption. So now in exam, if the similar question asks, you also take the second assumption that whatever annual departure rate has been given, that is for the remaining vesting period. This assumption will prevail now. Don't take the other assumption which I have taken in the class. Understood? So now we'll assume that this 2% annual departure rate is estimated for the remaining vesting period. First year estimation has been done for second year and third year. Second year estimation has been done for the third year. Understood? Now in the given question they have not given the number of employee. So number of employee can be calculated by way of back calculation. So you can see how many employee vested 492 and how many employee left 8, 10, 50. So if you add 492 plus 15 plus 10 plus 8, how much it is coming? 492 plus 15 plus 10 plus 8. So how many employees? So the total number of employees on grant date will be 525. This was missing in the question, so of course we can calculate this by back calculation. Now this question become very easy. So first year what will be our expense, batao? It will be 525. How many employee left? 15 multiplied, how many employee left? Minus 15 you'll do. This is minus 15. Okay, 525 right now, minus 15, and second year how many employee will leave? It is given 2%, 2 will do 98%, and then we'll do 98%. Understood? Similarly, for second year we'll take 525 minus 15 and minus 10 into what? Now 3% is the annual departure rate estimated, so we'll take 97% for the third year, and the last year will take actual number of employee, that is 492 employee. Understood? So this will be the calculation. Now this assumption will prevail. Now you can see the calculation that first they have taken that only into 100 option, 100 shares granted. Correct. What is the fair value of option for the first year? It is 42. So into 42 into 1 by 3 they have done. Correct. Means what they have done? 525 minus 15 into 98% into 98%. It is coming how much? 489.8. So 489.8 will become 490 employee. 490 employee into number of option, that is 100. What is the fair value of first year? Fair value of option is how much? It is 42, and we'll do 1 by 3. This become cumulative expense. Next year it will become 525 minus 15 minus 10 into 97%. So it is 485 employee. So we'll take 485 employee. Are you getting what I am saying? 485 employee into 100. What is the fair value of option that is given? 46, and you will do 2 by 3. Cumulative expense will calculate. The last year will be 492 into 100 into 48 into what? 3 by 3 cumulative expense. Then minus the previous year recognized expense, you will get current year expense. Correct? So they have given that only. This is the cumulative expense. This is the cumulative expense. Understood? And from this they have deducted the previous expenses. So we'll get what? Current year expense. Understood? This we can calculate. Understood? And the payment was done based on the intrinsic value. Intrinsic value was how much? 50 per share. So any difference on estimated liability and actual payment will be also transferred to EB expense, and it will be also transferred to profit and loss account. So we can do the SAR account. Means they have asked SAR ledger. This is nothing but SBP liability. The first journal entry will be EB expense debit to SBP liability. So we have credited with 6,86,000. This will become closing balance. Then once again will pass the next year EB expense account debit to SBP liability with the expense. This will become the closing balance. Then once again third year we have done EB expense account debit to SBP liability. This will become closing balance, and the last year opening balance this, and the payment will be done. Payment will be done SBP liability account debit to bank. As per the intrinsic value is 50. So 492 into 100 into 50. How much payment has been done? You can see payment has been done is equal to 24,60,000, and any difference in this account will be transferred to EB expense. EB expense, so EB expense become 98,400. Very simple. I hope nothing to be explained much about this. Only the assumption wala point I have explained. Ki in class I used to give alternative solution by taking two assumptions. But now it has been clear that ICAI in suggested solution they have taken only one assumption. So that assumption will prevail from now onward. Understood? Yes, sir. Of course, this SBP liability is this account is a liability because it's a cash settled SBP. So in this there is an obligation to pay cash based on the price of equity shares. Therefore, it will be an SBP liability. We can write down in our own simple words. One more question we need to discuss, which has been given in the RTP May 2002. It is a simple question, but I will say one new type of question. You can say Fashion India Limited entered into an agreement with RFD Limited on 10th August 2002 for purchasing a machinery. The agreement has a clause that FIL will have to settle the consideration of machinery purchase by issuing its own equity share. So this is the question of non-employee share-based payment. FIL agreed to the clause. An order was confirmed. Machinery was supplied by invoice dated 25th October 2002 and delivered on 1st November 2002. It means it was delivered on 1st November 2002. Agreed purchase consideration was 150 lakh The purchase consideration was 150 lakh and the fair value of machinery supplied was estimated to be 160 lakh. What is the fair value of machinery supplied was 160 lakh. As agreed, FIL issued 1 lakh equity shares of the face value 100 each to RFD Limited. As per Ind AS 102 share based payment, what should be the price and the date of recording of machinery purchased from RFD Limited? So date will be the date when the control of the goods has been received. The control was received on which date? On 1st November. So 1st November will be the date of recording. 1st November will be the date of recording, and as per Ind AS 102, this transaction was recorded in an amount equal to, means this the amount of the machinery recognized will be equal to the fair value of goods or services received. If it cannot be measured reliably, then we'll take the fair value of equity instrument issued. The first preference will be given to the fair value of goods or services received. So the amount will measure the amount of the journal entry will be what? 160 lakh. 160 lakh will be the amount of the journal entry. Means what journal entry will do? Machinery account debit. Machinery account debit. It is 160 lakh on which date? On 1st November 2002. Equity share capital. How many equity share capital they have issued? That is what? How much? They have given 1 lakh of rupees 100 each. So 1 lakh into 100. So it will become 100 lakh, and to securities premium it will be 60 lakh. That is the only answer. Let's read what is the answer given. For equity settled share based payment transaction, entity shall measure the goods or service received and the corresponding increase in equity at the fair value of goods and services received. Unless the fair value cannot be estimated reliably, if the entity cannot estimate the fair value of goods or service received, then entity shall measure the value and the corresponding increase in equity indirectly by reference to the fair value of equity instrument granted. Here, since the fair value of asset received can be estimated reliably, the price for recording the machinery would be 160 lakh. Further, control is assumed to transfer on the date of delivery is received, which is 1st November. Therefore, this will be the date of recognizing the machinery in the books of account. Understood? Simple question, but new type of question. However, similar question we have, but I found this question interesting. Therefore, I have informed you. Understood? The two question, new question. I hope you have understood. Correct? In this video, this much only. In the next video, again we'll meet with some new question from other chapter. I hope you are liking this video. All the best for your preparation. We'll meet again in the next video with the next question. Bye bye till then. Keep studying.